All right, we are ready to go. Really excited to kick this off with really good buddies of mine. So want to introduce myself. I'm the CEO of Sutton Capital. And I also want to introduce, the guest speakers here. Mark Young has been a good friend of mine. We've been really just having fun doing community building. So just real quick, I'll read Mark's bio, kind of give you an overview on him. He's the co-founder and CEO of Bridgepoint Capital, also the co-founder of Catterton's US $500 million Latin America fund, where he served as a partner investment committee member. He led the investment advisory division within McKinsey & Co.'s investment office, overseeing 10 billion in partner funds. He successfully implemented the endowment model, which I'm excited to talk about this evening, for over 3,000 McKinsey partners, achieving double-digit returns with low volatility during his tenure. He also co-founded a biotechnology company, Cambridge Neuroscience, raising 75 million of private capital from investors, including Warburg Pincus and the Harvard Endowment, before taking the company public. Graduated from Harvard Business School with an MBA degree in 1993 and has obtained both a CPA and CFA. So huge treat having Mark on the line. If everyone else can please go on mute, that would be great. Also want to introduce you to Randy Cohen. Randy, good to meet you and have you on the show today. So Randy Cohen is a senior lecturer at Harvard Business School. Please go on mute, guys. Can you guys all go on mute? I'm going to mute everybody. And then I'll get the speakers back on. So Randy Cohen, the senior lecturer at Harvard Business School, co-founder of Vision Capital Advisors, currently a senior lecturer of investment management and entrepreneurship at Harvard Business School. Dr. Cohen also lectures worldwide on investment management and valuation of hard to value assets, has published working papers on the subjects of alternative investment management, asset pricing and finance, and is a member of the American Finance Association and the European Finance Association. He has an A&B in mathematics from Harvard College and a PhD in finance at the University of Chicago. So we definitely have a heavy hitter panel today. Really excited to learn from the esteemed guest speakers. Really the topic that we're going to talk about today is 10 actions for surviving the post-rate hike apocalypse. So really excited to kind of talk through that. So Mark, you're unmuted. Randy, let me get you off of mute as well. So you're back here. If everyone else can kind of hold on mute until we get to the Q&A, that'd be great. So Randy, you able to turn your mic on? Let me see if I can help here. I just sent you a request to unmute. There you go.
All right, we got it. Okay.
All right, cool. Great. So sorry for that. And why don't we just jump into it? Really excited to kick this off. So one of the first things that I want to talk about as a theme is really the financial market performance this year has been terrible, right? So what are the major factors behind the drop in major indices? Inflation is now at 40-year highs. The Fed is responsible for fighting inflation. They've already raised rates twice this year. So how much more will they do and for how long is it going to take to get back to neutral? Couple other stats, the S&P has been down 16%, the NASDAQ has been down 26%, and the bonds are down 11%. So what are your guys' takeaways on that?
Well, if I may, let me just start on this one, and Randy will share his views on this one. I can tell you what the conventional wisdom is saying, and then Randy's going to give you I'll just say the keen insight that we want to share with everybody. But the conventional wisdom is that with full employment, and we're at record low unemployment, we're below 4%, that puts pressure on labor rates and that drives inflation. And clearly that is one data point, but there's many more. Food and energy are up a lot, and that's a recent phenomenon. And people are pointing to the war between Russia and Ukraine for the spike in fuel prices, and I'm sure that's a contributing factor. But there's some other things happening here. There's something called the base effect, meaning a year ago at this time, the economy was still struggling with COVID. the underutilization of resources, et cetera, there wasn't much pricing pressure in the markets. So that artificially understated things, and things now are rip roaring strong, and it's probably overstating things a little bit. But the fact is, the markets are reacting very negatively. And again, with the Fed, 2 rate hikes already, they've made a policy change post Alan Greenspan where transparency to the markets is essential. And they've signaled to the market that there'll be 3 more rate hikes this year. And at the moment, the market's expecting those hikes to be 50 basis points apiece. The last rate hike was 50 basis points as well. So that's more or less what is discounted by the market. And the market, as we know, has done very poorly. I think just the final thing I want to say before I toss this question over to Randy is the proverbial allocation of 60% of your portfolio in stocks and 40% in bonds, with the idea that when equities did poorly, your bonds would do well, and that would give you a smoother performance, or I like to say a smoother ride. Well, that hasn't been the case. And it's, for all of us, many people don't want to look at their statements right now, which, by the way, is the worst thing you can do. When there's bad news, you have to be as vigilant as when you have good news. So don't give in to that temptation. But the fact is, everyone's hurting right now. And that's why we are doing this podcast, because we have proven approaches to help people get through this. So Randy, tell us why the markets are rational, or why you think things are going to get better.
Yeah, look, you can explain an awful lot with the interest rate. There's a lot of things that people have found puzzling over the last few years make a lot of sense once you look at interest rates and remember how a discounted cash flow model works. In other words, if you think of a security, whether it's a bond or a stock or real estate or anything else, as delivering cash flows to you, and then they're coming in the future, and so you have to figure out what those future cash flows are worth today. And the higher interest rates are, especially long-term interest rates, short-term doesn't matter very much because anything that's coming soon isn't going to be that heavily discounted. But if you've got cash flows that are coming in 20, 30, 50, 100 years from now, well, then it's a huge difference whether you're discounting them at 2% or 3%. And so the thing that people found so mysterious when COVID hit was the market went from sort of 3,600 to 2,400. So it went down by a third. Bad news in the economy, COVID's going to be super disruptive. That made sense to everybody. Then the market went back up all the way, blew through the 3,600 into the 4,000. And people were like, what the heck is going on? But it was very simple to understand. The typical stock has a duration of 50 years. That is to say, the average time at which you're going to get money back from a company you invest in is something like 50 years in the future. You're going to get some money this decade and some money next decade and some money in 200 years, 500 years. Obviously, once you get far enough out, those are so heavily discounted, they don't matter much. But 50 is normal. So if you move the interest rate from 3 to 2, you basically juice the stock market by 50%, okay? And by the way, you juice the bond market, the long-term bonds, by 25%, and we saw the long-term bonds go up 25%, just as theory would predict. So that all makes sense, right? That's why the market was up so much, but we all knew that if eventually interest rates went back to 3%, again, this is for 30-year bonds, went back to 3%, well, you have to lose that same chunk. It has to come back the other way. And so that's the draw that we've been seeing is stocks going down. Now, Mark's point about the 60-40 is super important. I'm writing a paper with my colleague Luis Becerra, who's possibly the world's expert on the 60-40 portfolio. And what we show is that if you go back 50 years, you will see that 60-40 virtually never has a bad year, right? There's only one double-digit loss in like 50 years, and that is in 2008. And even that one wasn't that terrible. And it's for exactly the reason Mark said. When your stocks crash, your bonds protect you. You get a flight to quality. And so even though the bonds don't go up as much as the stocks went down, and they're only 40%, not 60, nevertheless, you have enough there to cushion the blow in a very significant way. But I've been giving speeches for the last year saying to people, you cannot expect that to happen this time, because the fear that people have is not of a stock crash. It's not a crash where people say, oh my gosh, we're worried about earnings not growing, and so we'll do flight to quality and put the money into bonds. What people feared was a bond crash where the interest rates went up and bonds went way down. And when your stocks crash, your bonds protect you, but when your bonds crash, your stocks will not protect you from that bond crash. They're going to go down right along with them because stocks are long-term assets. And so what we've gotten is exactly what should have been expected from rising interest rates. And frankly, we all kind of should have known that drop in interest rates from 3 to 2 that happened to smooth out the COVID crisis couldn't be expected to stay down that low forever. It just doesn't make sense for a 30-year bond to pay 2% forever. So I think this is all natural and expected, but it still costs you money. I mean, that money, we made that money 2 years ago, and now we're giving it back. And that is frustrating. And so what you need are strategies so that if the rise in interest rate continues, you don't continue to feel the pain. And that's what Mark and Bridgepoint have been working so hard to develop.
No, I appreciate that. You know, I had a quick question too. So the 60 and 40 have been a recommended strategy. What are some other permutations that you've seen as far as the splits across the asset allocation? I was just curious, like, what other people have kind of recommended historically? Has there been like a 30-30-30? I was just curious about that.
Well, let me jump into this one if I may. Firstly,
sure.
60-40 is still the convention, but people have obviously tweaked it. Actually, some of the big wirehouses, we'll let them be named nameless, have been advocating 70-30 because stocks have been doing so well, but obviously that was before this year. So it's still more or less pivoting around the 60-40 split. Now, the endowment model, which I think this might be a nice time to make some comments on the endowment model. The endowment model has a heavy use of what they call privates, meaning things like private equity, hedge funds, venture capital, things that basically a retail investor traditionally does not get access to. So those things are what are considered absolute return vehicles. So they're intended to make money in bull markets and bear markets. So the combination of public investments like stocks and bonds combined with private investments, things like private equity and venture. And Randy's going to, in a little while, share a product that he's developed called liquid private equity, which is actually really interesting and exciting. So I won't steal his thunder on that, but I will just mention on the private side, that's something that Bridgepoint is founded on. We invest in what we consider to be late stage breakthrough technologies in mainly the healthcare space, which frankly is also traditionally a safe investment during turbulent times because people get sick in good and bad times. But net, the endowment model we think is a superior approach, and we'll go into that in more detail later. But Randy, what were you going to say?
Oh no, well, in terms of the 60-40 thing, what was interesting is when interest rates got so low, I spoke to a person who was an investment advisor, and he was very concerned for his investors. He's saying, well, if they're only making 2% on their bonds, we maybe have to up the 60-40 and go to 65-35. That was his solution. And I was actually really rude. I feel bad about it, but I actually laughed and I said, have you ever seen that movie, There's Something About Mary? Do you know the scene when the guy talks about how 8-minute abs are this super successful thing, but he's going to beat them in the market by offering 7-minute abs? I'm like, that's what you're doing here when you talk about 65-35. If the interest rates rise, then the fact that you're at 65-35 is just going to make the situation worse. Your bonds are going to get killed, and your stocks are going to get killed worse. So I don't think there are any. So I don't think it's so much about that. What I would say is, look. First, let me say what I've been telling people for the last year, and then we can think about how to adapt it in light of the recent moves that occurred. When the interest rate was at 2, what I kept saying to people is, just don't have any money in bonds, right? The 40 doesn't make any sense. What you want to have is something more like 40% stocks, 10% in bonds, just to have a little in case something crazy happens, like interest rates going negative in Europe, that sort of thing. It just gives you some dry powder for that weird situation. And then you need to have 50% in other kinds of investments that are protected against an interest rate rise. So you have to look and see what are the kinds of investments that will continue to perform for you, even if interest rates are growing. Now, interest rates having gone from 2 to 3, obviously, we can all sort of sit and say, well, boy, I wish I'd made more of a move in that direction earlier. If we didn't, and I'm sure some of you did make a move in that direction, and if so, that's great. But I think it's still a good time to do it. In other words, it's not like there's any magic to 3 that says that interest rates can't get higher. I don't think it's necessarily going to be the case that interest rates are going to 4, 5, 6%, but 3% is still not a very attractive long-term return. And so then that brings us to the question of what are the kinds of investments that make a lot of sense in this environment. So let me pause, and Mark, if you want me to talk about some of the things in private credit and in liquid private equity, I can get into that now, or we can put that off till a little further in.
Why don't we, I think we had some planned questions. We obviously are going to cover that, but Joel, why don't you do the next question first, and then we'll move into the actions that we think people should be taking in this challenging market.
Yeah, so I think you guys tackled the question on 60/40. One follow-on question that I had, and then we'll jump to the next top 10 tips is, on the endowment model, we talked about 3%. What is kind of the benchmark when you look at portfolio allocation, in that industry when it comes to institutional investing? Talk to me a little bit, because you might have had some of this lens on benchmarking as far as portfolio returns. What is the benchmarking looking like for some of those different types of asset allocators?
Well, let me start with what we did at McKinsey, and I will also share with you the advisory board of the investment office was a similar composition for the Yale Endowment. So it's not an accident that their performance and their models and approaches are very similar. And by the way, Yale's endowment, its last fiscal year, keep in mind their fiscal year is not the calendar year, but it's a June fiscal year end, was up 40% for the year. Now that's a phenomenal performance, but the allocation, and this gets back to the allocation approach that I took for the 3,000 current former partners, was 40% ownership of equities, both public and private. Important point there. It's not purely public, but public and private was 40%. And by the way, the public equities were not single name stocks. We believed that what you wanted was the cheapest, what they call market beta, and that was done through ETFs, and it was the global stock market. So half of your equities, or 20% of your allocation, was in public stocks through roughly 5 ETFs that own the global stock market. The other half was things like venture capital and private equity, and the kind of things Randy's going to talk about in a minute. So that was 40% versus the 60 convention for the public. Another 30% were market neutral hedge funds. And again, that's something Randy will touch on. 15% was what was described as deflation sensitive, things like bonds, et cetera. And the other 15% was inflation sensitive securities, which is really the item that we want to attack on this call. And we'll go through the types of things that actually perform better in rising rates and inflation. And that was the model.
No, I appreciate you adding that context. It was really helpful, because I think as you deploy capital, you want to really think about what you should follow and kind of what the guardrail should be. So I really appreciate you adding that context. But let's jump right into it, Randy. So I know you got a couple slides and some best practices and actions that we can follow. So looking forward to going deep on this.
Yeah, well, that's right. I think of there as being 2 big categories to get into here. One is a sort of broad best practices, and then the other is some specific exciting ideas as to where Mark and I think that the great opportunities are now. And so I think let's let Mark take the lead on the best practices, because this is material that he and the team at McKinsey developed and that he's continued to expand and improve upon at Bridgepoint, and moreover has really honed in on, like, for this moment, what makes sense in this environment. So he'll take the lead, then he'll probably throw it to me to add a few add-ons, and then a little later, let's get into some really specific investment types that we're excited about as well.
Okay, well, thank you, Randy, for that comment. So inflation is clearly one of the outcomes of the market. You can have inflation, the opposite of inflation is deflation. And, in the last couple of years, we've had a taste of both. So the belief that today you definitely should have inflation-sensitive securities, meaning things that'll do well in an inflationary environment, should be part of your portfolio. And we believe that that's a core holding of your portfolio. It's not a market timing because inflation is a problem today, and when inflation is no longer a problem, you don't need it. Well, if you have an all-weather approach and a long-term perspective, inflation and deflation will come and go, and you should have that protection. So anyway, you also, go ahead, Randy.
Let me add a quick word on that. There's two ways to think of these inflation protected securities. Mark's going to talk about some asset classes that have that feature, and that's very important, but also within asset classes. And in particular, look, think back to the COVID crisis. When the interest rates went way down, what benefited the most? Well, if you just think about how discounted cash flow works, there are companies where most of the money they're going to make in the next few years. They're very profitable right now. And then there's companies where the profit is way out in the future, right? So think of maybe Tesla as an example of a company where the value is not because they're making so much money today, but because people think 20, 30, 50 years from now, they're going to make a ton. Well, they massively benefit if you cut interest rates, because all that money that's far in the future is discounted at 2% a year for 50 years instead of 3% a year for 50 years, right? So the companies that did the best when in the COVID crash were the companies that got helped the most by the Federal Reserve, and for that matter, by central banks all over the world, lowering rates. And that is the high growth companies, the Teslas and Amazons and Snapchats of the world, the companies where people say, yeah, they may not make much money now. I mean, Amazon obviously has become pretty profitable, but Amazon's enormous value is because of expectations of future profits, right? And the companies that did the worst were the companies that are successful right now, making money right now, because they didn't benefit as much from the central bank action. Okay, well, when that flips on its head, what is going to get hurt the most in this environment? It's going to be those high growth companies, those companies where the profit's all in the future, Carvana, DocuSign, et cetera, those volatile companies. And sure enough, of course, we've seen them get hit very hard. So when Mark says, have inflation protective assets in your portfolio and interest rate protected assets in your portfolio, think both about some of the kind of asset classes he's going to talk about, and also about tilting your portfolio to the right kinds of companies that aren't so sensitive to interest rates and inflation.
Okay, well, thank you for that, Randy. Counter-cyclical investment sectors. So what does that mean? Basically, economies go through typical cycles, and right now we had first quarter with a negative GDP. If it's unlikely, but if we have a second quarter that's a negative GDP, that meets the definition of recession. So if you have two negative quarters in a row, you're in a recession. I would say on top of that, the Fed's track record of engineering soft landings when they raise interest rates is pretty poor. Almost every time they do a rate tightening cycle, they overhike rates and the economy goes into recession. So they go from a tightening to an easing cycle in fairly rapid order. So bottom line, counter-cyclical investments, what does that mean? So let's start with things that benefit from inflation. So the Goldman Sachs Commodity Index is something that has been around for a very long time. And just as a data point, you can own the Goldman Sachs Commodity Index through an ETF, which stands for Exchange Traded Fund. And ETFs have typically the lowest expense ratios, and expense ratios are a zero-sum game. Either you pay the manager those fees or you don't have to pay and you keep it, it goes into your gain. So we like ETFs a lot, and stocks have a lot of benefits associated with them that other instruments don't have. So bottom line, the GSIC is up 42% year to date. And yes, there's a large component of oil in there, but there's other things as well, things like copper that are real assets, i.e. commodities, and we're in an environment where real assets are doing very well. There's a couple other, go ahead, Randy, what do you want to say?
I was just going to add, I absolutely think, look, it makes sense to have a diversified portfolio that benefits from all asset classes. And commodities are one of those asset classes. And so it makes sense to be invested there. And the only thing I'll say is like if you don't know a lot about commodities, make sure that when you invest in them, you talk to professionals, right? Obviously, we'll be thrilled if you're talking to Mark and the Bridgepoint team, but if it's not them, find other professionals that really know this stuff, because in my class at Harvard and also when I was teaching at MIT, I had Goldman Sachs' top oil expert come to speak to my class because he was a friend of mine from grad school named Jeff Curry, brilliant guy. And he explained how easy it is to be right about the direction of the movement of something like oil prices, but that if you go and trade it in futures markets or whatever, it's like you'll be like, wait, oil, I thought oil was going to double, and it did double, and yet I didn't make any money because of the way that futures work, the way ETFs work. It's pretty complicated stuff. And I personally am not expert in it, so don't call me for advice, but do call Mark or call somebody because it makes sense to have commodities in your portfolio, but you want to make sure you do it in a smart way.
Okay. So basically, we're going to go through 10 items. We've just touched on 2. Yes, you should have inflation-sensitive securities in your portfolio. That's item 1. Item 2, examples of things that will directly benefit in an inflationary environment. We mentioned the Goldman Sachs Commodity Index up 42% year to date. There are other things along similar lines. There's something called the Wisdom Tree ETF, which again is a commodity strategy that's up around 24% year to date, so not as high as the Goldman Index is. There's ETFs of ETFs called RAAX, which is up 10%. There's gold mining companies, because gold tends to do well because it's a real asset. Although, frankly, the performance year to date is kind of muted. It's up around 3%. And I can go on and on about these asset classes, but gold is typically considered negatively correlated to the US dollar. So when the dollar is doing poorly, gold does well, and vice versa. Well, this year with the Fed rate hikes, the US dollar has done very, very well. There's an ETF that tracks the dollar as a global index. That's up 8%. So that index, if you wanted to own, is called ticker UUP. And those are examples that we have to share with the rise in rates and spiking inflation. So the number 3 on our top 10 list is what we call a volatility hedge. And this one I equate to playing with dynamite or dropping nitroglycerin. It can blow up on you. So this one I'm not a big advocate of because it requires market timing, and that's almost impossible to get right. But there's something called the VIX, which is basically a 30-day forward look at where stock volatility will be. So it's a perspective today. They call it the fear index. And typically, VIX long-term volatility average is less than 20%. So when it's above 20, it's an indicator that the market is really nervous. It's fearful. So the bottom line, the VIX futures ETF is up 35% this year. Not surprising because we're all fearful right now what's happening in the market. The 4th item is what I call flight to value, meaning when people are anxious, Randy was pointing out the idea that think of stocks as a discounted cash flow. So things that are more certain, more near-term cash is likely to do better in this environment than things that are longer term and more uncertain cash flows. So the king of value investing is Warren Buffett. And you can buy Berkshire's stock and it's up about 5% year to date. When the S&P is down significantly, he's massively outperformed the stock market. Even though 5% isn't extremely exciting, it's a hell of a lot better than being down 20 or 30.
And by the way, good example of what I was talking about before, where if you invest in the kind of stocks Warren Buffett like See's Candy and Coca-Cola companies that are actually making money now, they're much more resistant to these kinds of interest rate moves. Don't get me wrong, there's a time to buy Tesla, right? You could have made crazy money buying Tesla over the previous 5 years. It's not to say, oh, it's so obvious, just do what Warren Buffett does. There are different strategies that are right for different times. And that's why it's important to, talk to people who are really thinking about the markets day by day and saying, where are we now as opposed to where we were in the cycle 2 or 3 years ago.
Okay. The 5th item on the list is what we describe as tail risk protection. So Randy, do you want to discuss what tail risk means and why that can be helpful in the current environment?
Absolutely. You know, what's hugely important is to make sure you just don't get hit too hard when bad times come. It is amazing the power of that, right? If you could just take all the bad market crashes and turn them into, let's say, only losing 10%, then the total amount of money in your portfolio, even if you don't outperform at any other time, would be dramatically higher, probably 5 or 10 times higher over the course of a few decades, just from cutting off those extreme losses. And there are various ways to get crash protection in a portfolio. Options are one way, and of course, Mark was talking about the VIX, which is a measure of option characteristics, and that's one approach. There are other things you can do in terms of, you know, sort of essentially buying insurance against extreme movements in the market. I was actually just talking to one of the world's top experts in this area, and he was recommending an ETF that shorting or buying put protection on the BKLN, which I thought when he first told me about it a few months ago, I thought, is that some kind of Brooklyn-based index, the BKLN? But it turns out BKLN, of course, stands for bank loan, not Brooklyn. And the bank loan index, he said, the way it works is if the market's down 15% like it is now, it's barely going to budge. Those bank loans are all going to pay off. But if the market falls 30%, like it did in 2008, or 40%, that thing is going to lose so much. And if you bet against it, you make a fortune. So in other words, you don't have to pay a lot when times are good, because it doesn't move that much just because times are good. The loans are still paying off, but it really protects you in extreme cases. Now, that's just one example, and there are lots of ways to hedge against extreme moves. But if you can make a situation where, hey, if it's down 10, we'll take the 10% loss, we can tough that out, it will be back. But make sure that you don't take those 25, 35, 45% losses, hugely important.
All right, well, thank you. The next item is something near and dear to both Bridgepoint and Randy, which is owning absolute return strategies, private equity, venture. And we suggest doing that through SPVs, which stands for special purpose vehicles, which for us means your fund is one asset in a separate legal entity that you can invest in. So we like it a lot because, number one, there's transparency. You know what you're buying. And we give our investors the option to participate or not in a deal. And that tends to be the proverbial win-win, because the manager has to source something that has demand on the market and has to basically earn its trust of its investor base every day. And we embrace that challenge. So Randy, would you like to share with the audience what I affectionately refer to as liquid private equity?
Yeah, I appreciate it very much, Mark. You know, this is Mark knows this is my pet project. I gave a speech at Harvard Business School to a group of institutional investors in 2000, 22 years ago. I can't believe it seems like only yesterday. And I argued, look, I said, private equity is the best performing asset class. It beats the stock market on average by 2 or 3% a year. Obviously, if you can get into top quartile private equity, you do even better than that. But let's just say even average private equity, you're beating the stock market. But when the market crashes, private equity doesn't take such large markdowns, right? They generally drop about half as much as the market in a big crash. So you get that tail risk protection, but you still preserve the upside. So it's very attractive. Why don't people have more money in it? 2 problems. One is lack of access. The other is lack of liquidity. So let's talk about access for a second. It's obvious, typically you have $1 million minimum on a private equity portfolio. So obviously that's going to make it very difficult if you've got a 401k plan with $40,000 in it or something like that. But what's interesting to realize is that you could be extremely wealthy and still struggle to invest in private equity. If you have $8 million, right, that's a pretty wealthy person. But if you want to create an institutional type portfolio, which would normally be about 20% private equity, that would be $1.6 million. You could only make the minimum on a single fund. But you'd be crazy to put 20% of your money into a single private equity fund, because a single private equity fund probably only has 8 companies in it. They're levered, right? Private equity is leveraged buyout. So they're levered, they're very small. So that would be too risky. What you want to do is put 20% of your money into a portfolio of 20 private equity funds, right? But for that, you need to have $100 million or something like that. Now, there are various ways of attacking this problem, okay? And one way is to work with some kinds of special purpose vehicles that Mark creates, okay? And that is one solution. There are things you can do with private equity fund of funds. Those have some issues with fees and quality of underlying funds, but still but the solution that I've been working on for all this time and actually have created a business to pursue is called liquid private equity. And essentially what we do is use the public markets to create a portfolio that copies what private equity funds do and does the exact same things they do, but in public markets. And so therefore you can get your money anytime you want, because the second biggest problem with private equity is liquidity. Even if you can access it, you have the tremendous difficulty that it's triple illiquid. First, you can't take your money out when you want it. It's locked in. Second, they call you at unexpected times and say, hey, we need you to send us another $170,000 by next Tuesday. And that can be very stressful and makes it really hard to manage the rest of your portfolio. Third, exactly when you have your portfolio just the way you want it, they call you up and say, hey, good news, we had a successful exit. We're sending you a bunch of money. And you're like, but wait, now I'm out of balance. Can I just put that money right back into private equity? And they say, well, sure, you can invest in our next fund. It closes in November. And you say, but is my money in private equity then? And they say, well, no, actually, we'll be doing capital calls for the next 7 years, right? So it's very difficult to manage the access and liquidity problems of PE. And liquid private equity is not here to replace private equity, but it's here to help people. If you can't get access, this does the job in your portfolio that private equity does. And if you can get access, it helps alleviate liquidity problems. And so that's why we developed it. I actually have a company that I developed with one of the top people in private equity. We've been doing it for several years, and it's called PEO Partners. So anyway, it's something we're really proud of, and we think is just one solution. What I want to highlight about PEO Partners is, as wonderful as I think it is, and as hard as I've worked on it, the points Mark's making is that to build a great portfolio, you need a lot of pieces in the puzzle to get the right kind of diversification, the right kinds of downside protection, the right kind of upside protection against inflation risk, interest rate risk, and so forth. And liquid private equity is one of the things that delivers part of the solution.
It's one of the tools in the toolkit, as I'll say.
That's right. Exactly right.
Well, on top of, I'll just say the private equity, venture, et cetera, item 7 on the list of 10 is private real estate. And yes, there's ways to get access to public real estate as well. But the thing about private real estate, firstly, these private real estate deals tend to be niche-y, meaning institutions can't deploy enough capital in them. So they're not extremely efficient. So that's actually a good thing because you can get higher returns. And we have people we're working with today that have essentially what I'll call fractional ownership of real estate. So you can have a small ownership in a property or multiple properties as if you were the majority owner, but you don't have someone else is taking care of all the headaches. So real estate for individuals in the consumer space, because basically real estate's like Baskin-Robbins ice cream. There's 31 flavors. So is it office buildings? Is it warehouses? Is it multifamily houses? Is it apartments? There's all kinds of real estate in all kinds of markets. So we do have someone that is a specialist in, I'll just say, residential real estate in part of the world that's near and dear to both Randy and I. It's Cambridge, Massachusetts. So bottom line, in that market, which is extremely tight, MIT and Harvard aren't going anywhere. And by the way, it's become the home of the global biotech industry, and that's not going anywhere either. So there's a huge scarcity of residential properties in that market. And the person that we're affiliated with has done this literally a couple hundred times. So he's been very successful at it. And at a future date, we'll share that with this audience if they're interested. So private real estate, by the way, today, the current income or current yield that people can get on private real estate, yeah, it varies, but for the things we think are relatively low risk, there's nothing that's risk-free, but relatively low risk is about 8 to 10% a year current yield. And if you want to own the asset itself, you can get total returns over 20%. So real estate or private real estate was the 7th item on our list. Now,
can we unpack real estate a little bit, Mark? So when you say real estate, what are the attractive opportunities that you're seeing? Is it residential? Is it commercial?
Residential. Maybe again, I could spend a little more time on this. So think of all of us, if you're renting today, well, the landlord can basically jack up your rent. So in effect, you have a built-in inflation hedge because your cash flows as a landlord are going to adjust for, inflation. So that as an owner of real estate, it has a built-in hedge. And on top of that, the asset itself, the replacement cost of a house today, it continues to rise. And we haven't even talked about the logistics or supply side bottlenecks. So there's a labor shortage to build houses. You can't get people to build them today. And
there's a timber shortage.
Yeah, and you can't get raw materials. So those combination of things also boost the value of real estate.
Yeah, and I think there's two things. I mean, especially being a New Yorker, right? There's the, when you're looking at your goals, you may want to have appreciation, and then you also want to have cash flow. And getting both of those things are ambitious things now, especially with just the prices going so high. So what are your thoughts on that? And for me, I've been also looking in like the Midwest, because the Midwest, some of the prices are still reasonable, but like, anything on the East Coast, especially now Florida, that used to be a great place to kind of invest, it's those prices are getting jacked up. So for me, I've been kind of seeing some interesting opportunities in the Midwest where you can still get some multifamily properties for reasonable price, and then there's possibly some appreciation opportunities too. But those are kind of like two frameworks that I look at. There's also just tax benefits in real estate too. But any other things that we should be thinking about when we're vetting deals as a framework for real estate opportunities?
Well, I think you hit on the high points. We can get into a lot more detail, but we'd probably be better served to do that on a separate chat. But bottom line, we have models that underwrite real estate. So firstly, yes, you want as much current cash flow, or what they call current yield. And think of current yield on a real estate asset is the coupon of a bond. So they have ways of saying things like, what's the coupon rate, or they call it the cap rate. And that's the yield your real estate investment will generate on a piece of property. So you can then compare your cap rate on real estate to what you would own if you wanted to buy a bond, or dividend rate on a stock. So you have different ways to measure if you're getting a good deal or not. And this is before we even talk about the tax benefits of real estate, which are tremendous. Okay. But you are owning an asset that requires maintenance. And there's so much, I'll just say, leakage in real estate. You have to be so careful about this. So you can think you're buying a great asset and not make any money because the manager is overcharging for things, or making money at your expense. So there's a lot of diligence you still have to do. You don't just blindly buy real estate because you like the category. So at another time and place, we're going to go through a session on real estate where we can go over all these things in much greater detail. So anyway, that's where I am on number 7, which I'm saying is private real estate. So the last 3 items I think are all pretty interchangeable. So firstly, number 8 is rebalancing your portfolio. So whatever your target allocation is, I gave you the target allocation that would have been used for the partners that I work with. But traditionally, you would maybe rebalance once a year. But right now, with the volatility in the market, rebalancing quarterly, we think, is a prudent strategy. So that's number 8. Number 9 is, we're pretty much all taxable investors on this call. So wherever you can get what I affectionately refer to as deferred tax vehicles, taxes are bad, push them out and pay them as slowly or as late as you can. So things like private placement life insurance, which again, we deployed very successfully at McKinsey, essentially create another vehicle where you can wrap your tax inefficient assets in an insurance policy, and all those gains are compounding tax-free. And they essentially act as the death benefit of the policy, plus they have cash surrender value. So you can borrow on your policy to get access to your money. So it's really clever and innovative, and a great way to postpone or avoid taxes on your portfolio. And the last item on the list, and you can call this shameful promotion, but it's really not. And that last item is consider joining a mastermind group. So firstly, McKinsey was a mastermind group. Things like Tiger 21 are a mastermind group. Things like Bridgepoint Capital has a mastermind group today. And that's something that we're making available to people if they're interested. And if you are, there'll be a link at the end and you can reach out to us and we can describe in greater detail. But why would you want to do that? Well, firstly, there's an expression that I believe in, which is your network is your net worth. Your network is your net worth. So having an important network like a mastermind group, and you'll see later on the people like Randy Cohen who are part of Bridgepoint's mastermind group. It's a very powerful, resource-friendly network that you can benefit from. You can get access to our business deals. You can share your business deals. You can get advice and counsel. You have a community of like-minded people to help you. And having as many smart people surrounding you, the odds are you'll do better. And you gain from all their experience and their knowledge. So we're making that available. And those were the 10 items. So Randy, any thoughts? Anything you want to fill in the gaps?
No, I think that does a great job, covering kind of the big picture things that people really need to keep in mind as they analyze their portfolio and so forth. And I think a lot of us end up, look, we're all super busy. We all have, careers, families, lives, things that and it's very easy to just kind of let the portfolio go. And so, for example, your point about rebalancing, and so it's so important for people to say, hey, we have to kind of review things consistently and make sure that we're capturing the benefits of everything that's possible to do in investing. And so, find the right people to work with and really figure that out. There's huge payoff from it. Just be kind of, it's just like, changing the oil on your car or anything else. You just got to make sure you take care of business if you want to get good results.
Yeah, so we got a couple questions here. So Luce, you want to share your question about crypto? And if he's having trouble connecting, I guess the question was just, what do you guys think about crypto? How does that play into the mix of portfolio construction? Does that just kind of be part of your security strategy? Do you consider that a security?
I actually do have I have a comment on this. I've been giving speeches for many years. I wrote a paper on crypto back around 2016, 2017.
Yeah.
And I started giving speeches and I said, look, there are two reasonable allocations to crypto, 0% and 2% of your money. Mm-hmm. Now, obviously, there's nothing magic about 2, but I'm trying to be a little concrete about it. And what I said is, look, this seems like the ridiculously useless piece of advice. Oh, so either you should have some or you should have none. You're not telling me anything, Randy. But what I can tell you is that almost everyone I knew disagreed with me. Almost mm-hmm. everyone I knew either thought only 0 was a reasonable allocation of crypto, that you were crazy to put money into it because it was all snake oil. Or they thought crypto is the most amazing game-changing thing ever, and you should have somewhere between, a quarter and 100% of your money in, right? And so I'm here to disagree with those extreme views. On the one hand, I don't think it's crazy to stay out of crypto and say, you know what, I'm not going to swing at this pitch. I don't, if you don't understand it, and you just say, I want to, just avoid it. We'll let other people, fortunes will be made, fortunes will be lost, crazy stuff's going to happen. But I don't have to be involved in every new thing that comes along. I think that's totally reasonable. I also think it's reasonable to say, you know what, I want to have a little allocation here. This is something that is going to be important in the future. And so I want to be along for the ride in some sense. And that would be something like a 2% allocation, which I think would appropriately reflect crypto's role in society. Crypto is not half the world, but it's not nothing either. And I do think there are real valid use cases that will be value added over time. Now, the last thing I'll say is, if you're going to put 2% in crypto, I don't think it's crazy to just buy a Bitcoin ETF or even directly buy Bitcoin if you want. But my own view would be, I would prefer, and in fact, this is what I have actually done, to put money in a fund with people who choose which tokens to be in at different times and really understand the markets, get out of the market or get flat in the market. They can short as well as go long. They can take advantage of yield farming and other less well-known approaches to investing in crypto. And so to me, find a real expert, let them do your crypto, don't invest too hugely. So if the whole market goes to nothing, you're not wiped out. It's just, you can sort of say easy come, easy go. But at the same time, if crypto has another 10x in it, you can be along for the ride for that. That to me seems like a pretty reasonable way to think about crypto.
Yep, that's fair.
If I could just build on that point, the Yale Endowment basically a couple of years ago allocated 5% of the endowment portfolio to crypto. Now, 5% is kind of like Randy's, I'll dip my toe in the water, but if it goes to zero, I'm not wiped out. And it's consistent with that point of view. The fact that the Yale Endowment is 40 billion, 5% is a big number. So that's, $20 billion from Yale going to crypto.
2 billion, yeah.
But by the way, there's news on crypto on a daily basis. So firstly, last week, Fidelity announced they plan to let their 401k investors get access to crypto. That was last week. And that's got a lot of controversy around it, but I won't bore you with those details. And then this week, the SEC is making noises that they're going to consider crypto a security and basically regulate it. And I can tell you from my knowledge, the SEC is definitely not bullish on crypto and they're making it difficult. So we'll see how all this plays out. But there's this regulatory, sort of Damocles over the market's head. And that's pretty daunting. If you wake up and suddenly the US government bans crypto, I'm not saying they would, but that could happen. So that's why you don't want to have too much because of the risks. But the returns have been tremendous. Bitcoin was up 70% last year. So there's money to be made. But I would also encourage you, the person asked the question, on Wall Street, there's an expression, no one ever got fired for for making a profit or cashing in a gain. So it's okay to take money off the table and then be playing with the house money. So try to manage the equity in your crypto investments and preserve capital.
Yeah, that's helpful. I mean, I've talked to a couple institutional allocators and they've just classified crypto as immersed in their venture capital strategy. So it just kind of is considered VC and technology. So I've seen it kind of bundled in that bucket as well. So that's kind of what I've seen. So any other questions or comments? We got about 7 minutes.
By the way, Joel, I think there was another slide. Do you want to just scroll down?
Yeah. Nadia, you got that one? There we go.
Okay. So this is just a testimonial from one of our clients, and he was kind enough to let us use his name, which we typically would not do. But Allan Houston is not only an amazing athlete, but an amazing person. He lives in Greenwich, where I'm from. He's basically the general manager of the Knicks farm team, which they call the G League. And he's involved in a charitable organization that Bridgepoint is also helping with. I won't bore you with those details now, but an amazing guy, and we're happy to help him. So just, if you don't mind, maybe just go to the last slide as well.